Hey everyone, so in this video, I'm going over my top 7 stocks for the month of December 2021. In the last month, I've researched hundreds of different companies, and this is my list of stocks I think are solid buys right now. I encourage you to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Thank you to WeBull for sponsoring this video. Let's get started. So the first stock on my list is Pubmatic, stock ticker PUBM. Pubmatic is an advertising company that basically connects publishers with advertisers so that advertisers can find the space they need to market their products, while publishers earn revenue by marketing these products through the respective platforms or businesses. So right now, one share of Pubmatic is trading at $37.69, with a 52-week low of $21.61 and a 52-week high of $76.96. If we take a look at the 1-year price chart, we can see that 1 year ago, Pubmatic was trading at about $25-30 per share. It quickly rose at the beginning of 2021 all the way to above $70, and since then it's really dipped in price with a recent increase. They have a market cap of $1.934 billion, a P ratio of 52.94, and an earnings per share of 71 cents. Right now, Yahoo Finance is labeling this stock as undervalued. Now, looking at the valuation measures, we see a price to sales ratio of 9.24 and a price to book ratio of 8.76. Their current profit margin is sitting at 22.73%, and they have a really great return on equity of 28.69%. Looking at their balance sheet, we can see that they have total cash of $136.73 million, and they have a very respectable current ratio of 1.77. It's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Pubmatic as a 1.9, meaning it is a buy. And the average analyst price target is $52.90, which is close to 50% higher than the current price of $37.69. The company IPO'd in December of 2020, and within less than 1 year has nearly doubled in price. At the beginning of November, the company announced earnings that blew analysts' expectations out of the water. So the stock consequently skyrocketed by 20% the next day. Pubmatic specifically reported a year-over-year revenue growth of 54%, a year-over-year net income growth of 117%, and a year-over-year adjusted EBITDA growth of 81%. 40% more advertisers were spending more than $1,000 on the company's platform compared to last year, with a total of more than 60,000 advertisers placing ads on Pubmatic in Q3 of 2021. What gives Pubmatic its moat is the fact that it stores its data in-house with its global cloud-based infrastructure, whereas competitors such as Magnite rely on third-party databases. The company recently reported that companies Verve Group and Stream Malmo increased their reach to 21% by activating Pubmatic's ID5 ID feature. This basically allows advertisers to connect to larger markets without the need for cookies, which could soon be eradicated by Apple and Google. Pubmatic clearly has a comprehensive understanding of the market and its challenges, and has already proven it's ready to address and tackle these challenges. Being that this company has already showcased its strength and competitive advantage within less than a year since its IPO, this should be a company that you keep on your watch list. Alright, the second stock we're talking about today is Meta Platforms, stock ticker FB. Meta Platforms, formerly known as Facebook Inc., is an American conglomerate primarily known for its Facebook social media platform. Meta is also the parent company of Instagram and WhatsApp. So right now, one share of Meta is trading at $333.12, with a 52-week low of $244.61 and a 52-week high of $384.33. If we take a look at the 1-year price chart, we see a pretty substantial growth in the last year, starting from about $275 1 year ago, gradually creeping all the way up to above $375 with a recent small correction. It's a gigantic company with a market cap of $926.66 billion, a P ratio of 23.84, and an earnings per share of $13.97. They have a 5-year expected PEG ratio of 0.94 and a price to book ratio of 7.11. Looking at their profitability, they currently have a profit margin of 35.88% with a very great return on equity of 32.1%. They're sitting on total cash of $58.08 billion with a very, very great current ratio of 4.23. Analysts love Meta and they are rating it as a 1.9, meaning it is a buy, and the average analyst price target is $401.93, which is about 20% higher than the current price of $333.12. So Meta Platforms is one of the largest tech companies in the industry, with over 3.5 billion people using Facebook, Messenger, Instagram, WhatsApp, and Oculus VR per month. What's more impressive is that despite its relative seniority over other tech companies, Meta continues to grow at a remarkable rate. In its most recent earnings call back in September of this year, the company reported earnings of $29 billion for the quarter, which was a 35% year-over-year increase. The biggest thing going on for Meta right now is its name. CEO Mark Zuckerberg decided to rename the company from Facebook to Meta because it was more representative of what the company was trying to become. Right now, Meta is trying to better reinforce the metaverse as a potential future digital universe for users through the use of virtual and augmented reality technology. Meta Platforms already has a solid foothold in the VR market with its ownership of Oculus VR tech, and I literally just bought one the other day after trying my friend's app. It was honestly that cool. Also, Meta, being one of the largest companies in the world, has the resources necessary to pursue this vision of creating the metaverse into something fully mainstream. Meta has already proven its competitive durability in the market for nearly 2 decades, and the fact that the company still has other larger, more ambitious plans to follow only forecasts its future strength and potential. I personally believe that Meta Platforms is a relatively safe and secure investment and should continue going up in value for decades. If you guys want some free stocks in crypto, WeBull is giving away 2 free stocks worth up to $2,300 when you use my link below. You'll also get $5 in free crypto when you make your first crypto trade. Now, if you guys have watched any of my videos, you'll know that WeBull is one of my go-to investing apps that I personally use. They are a zero commission stock trading platform that makes investing easy and enjoyable. You can buy stocks, crypto, ETFs, trade options, the list is endless. And say for example, you want to invest in Amazon. One share of Amazon stock is about $3,500, but with WeBull, they'll allow you to buy partial shares, meaning you can buy, let's say, 1/10 of a share for $350. You can also invest in the most popular cryptocurrencies available if you want to take advantage of those sweet crypto gains. Now, beyond that, they also have paper trading, which is great for learning, and also free full extended hours trading. You won't find that with many other platforms, which is one reason why I am such a fan of their app. Like I mentioned earlier, right now you'll get 2 free stocks when you sign up and deposit just 1 cent or more. Those stocks have the potential to be worth up to $2,300. And you'll also get $5 in free Shiba, Doge, Bitcoin, Cardano, or Ethereum when you trade just $1 or more of crypto. I definitely recommend using my unique link below to claim your free stocks and crypto. Again, my link will be below to get your freebies today. And now back to the video. All right, the third stock we're talking about today is Unity Software, stock ticker U. Unity Software is an American video game development company that is known for its licensed game engine called Unity, which is a video game creating platform. Some notable video game titles with Unity include Cuphead and Hearthstone. So right now, one share of Unity is trading at $179.89 with a 52-week low of $76 and a 52-week high of $210. Their 1-year price chart shows that about 1 year ago, they were trading over $150 a share. Saw a big decrease in price back at the start of 2021. And since then, it's really jumped up in value. They have a market cap of $51.451 billion, no PE ratio since they are not yet profitable, and an earnings per share of negative $1.63. They have a price to sales ratio of 51.18 and a price to book ratio of 26.43. Now, like I mentioned, they are not yet profitable with a profit margin of negative 44.77%. And the return on equity is also negative at negative 22.57%. However, they do have yearly revenues of over $1 billion. According to their balance sheet, they have total cash of $1.28 billion and they have a really great current ratio of 2.83. Right now, analysts are rating Unity as a 2, meaning it is a buy, and the average analyst price target is $166.76, which is actually under 10% lower than the current price of $179.89. So Unity Software has been an important player in the video game industry recently because of the implementation of its 3D game engine, which is a potential avenue for video game creators to consolidate a future metaverse through Unity's technology. And looking at Unity, historically, the company's engine has been involved in the development of a ridiculous amount of video games. In fact, one article from 2015 reported that Unity's engine was responsible for the development of 174,000 video games in one single summer, which is just mind-boggling to think about. You can absolutely make the case that Unity has not only suggested its future growth potential, but has also historically proven its durability as a company. Unity recently announced earnings on November 10th, reporting a revenue of nearly $290 million, a ridiculous 42.6% year-over-year growth in revenue. And while the company's net income for the third fiscal quarter of 2021 was in the negatives, leaving a lot more to be desired, the fact that the net income still increased by about 20% year-over-year could suggest a positive trend for the company. And yeah, hopefully that will eventually lead to profitability. Unity is such a valuable and pivotal company operating in an industry that seems like it's only starting to grow. I think the stock is a winner and I will be adding it to my portfolio. All right, so the next stock on our list is ServiceNow, stock ticker NOW. ServiceNow is an American cloud computing software developer geared towards the business workflows of enterprises. So right now, one share of ServiceNow is trading at $649.55 with a 52-week low of $448.27 and a 52-week high of $707.60. Their one-year price chart shows that their stock was moving sideways at the end of last year and at the start of this year, but ever since June, we saw a very big price increase. They have a current market cap of $129.26 billion, an astronomically high PE ratio of 595.37, and an earnings per share of $1.09. They have a 5-year expected PEG ratio of 2.69 and a price-to-book ratio of 35.86. Looking at their profitability, we see a profit margin of 3.99%, and a return on equity of 7.1%. And in the last 12 months, they have hit revenues of about $5.53 billion. Their balance sheet shows that they're sitting on about $3.03 billion in total cash, and they have a current ratio of 1.13. Analysts do love this company a lot, and they're rating it a 1.7, meaning it is a buy. And the average analyst price target is $730.71, which is over 10% higher than the current price of $649.55. ServiceNow has the Now platform that basically allows users, which are often large companies that consume ServiceNow's products, to do things like manage data, securely store information about administration, search keywords that pull up important or relevant information within the company's software infrastructure, and other important functions of day-to-day business. This product seems especially important in an increasingly digital and remote world. And yeah, this product has been used by some of the biggest names in business. For example, for the past year and a half or more, ServiceNow has been working closely with Adobe and announced back in May of 2020 the collaboration of Adobe's Experience platform with ServiceNow's customer service management. This partnership validates the legitimacy and shows how powerful ServiceNow's cloud computing technology really is. ServiceNow announced earnings about a month ago, reporting a total revenue of about $1.5 billion, representing a 31% year-over-year growth. What's even more impressive is the reported net income of $63 million, representing a staggering 385% year-over-year growth in net income, as well as a diluted earnings per share ratio of 0.31, a 417% year-over-year increase. So clearly, ServiceNow has shown through its recent financial performance that it knows how to bring in large amounts of money while minimizing expenses. With its unique business model that will likely remain relevant and in demand for the foreseeable future, I'm definitely going to be putting this company on my shortlist. All right, next up we have NVIDIA, stock ticker NVDA. NVIDIA is an American tech company that is known for designing graphics processing units, as well as chip units that are used in electronic devices such as gaming consoles and PCs. Right now, one share of NVIDIA is trading at $315.03 with a 52-week low of $115.67 and a 52-week high of $346.47. Their one-year price chart shows that 1 year ago, their price was moving pretty sideways, but starting in May/June of this year, their shares shot up dramatically for a good reason. They have a current market cap of $785.055 billion, a PE ratio of 97.14, and a small dividend of 0.05%. They have a 5-year expected PEG ratio of 3.38 and a price-to-book ratio of 33.35. So NVIDIA very recently hit a new all-time high price in its entire history on the market, after reporting a 50% year-over-year growth in revenue and an insane 84% year-over-year growth in net income during its last earnings call. And when we revisit the price history of the company's stock ever since its IPO, we can see that NVIDIA has experienced really great growth for the past 2 decades. This is because NVIDIA caters to not one, but several large markets that have been growing rapidly for the last few decades. Much of NVIDIA's revenue comes from its gaming sector, with NVIDIA's RTX GPUs specifically in high demand. And naturally, to stay competitive in the gaming market, NVIDIA must work to create better and better products as soon as possible. And that's exactly what they are doing right now. Many speculate that NVIDIA's newest GPUs, codenamed Ada Lovelace, which should be released in 2022, will be twice as fast as their current cards. This technological advantage could be more special than you think because more powerful GPUs can accommodate production of more advanced computers, showcasing NVIDIA's ability and influence to enhance the markets and business that accompany it. And if anything, the speculation and hype surrounding these Ada Lovelace GPUs will be a good sign for NVIDIA stock, and the fact that I see gaming becoming more and more mainstream with the metaverse adding to that. NVIDIA has been a consistent winner ever since it went public and since I started talking about it on this channel, and I don't see any signs to suggest that it's slowing down anytime soon. So yeah, that's why I'll be putting more of my money into this company. Okay, so next up on my list is CARMAX, stock ticker KMX. CARMAX is an American company that is known for selling used cars. The company is also known for its no haggle policy, meaning the upfront price of vehicles is completely transparent and cannot be negotiated. Right now, one share of CARMAX is trading at $145.75 with a 52-week low of $90.30 and a 52-week high of $155.98. Their one-year price chart shows pretty consistent growth for the last year. They have a market cap of $23.628 billion, a P/E ratio of 20.71, and an earnings per share of $7.04. They have a 5-year expected PEG ratio of 1.26 and a price to book ratio of 4.86. In terms of profitability, their profit margin right now is 4.28%, and they have a great return on equity of 26.24%. They're sitting on about $58.09 million in total cash, and they have a great current ratio of 2.74. Analysts do like CARMAX, and they're rating it as a 1.9, meaning it is a buy, and the average analyst price target is $151, which is just a bit over the current price of $145.75. So in CARMAX's most recent earnings call, the company reported net revenues of $8 billion, approximately representing a 47% year-over-year growth. The company also reported sale of nearly 420,000 used vehicles, which was a year-over-year growth of about 20%. However, while CARMAX still profited this quarter, the company's net income decreased by nearly 4% year-over-year. However, this figure also represented an 8% increase compared to the prior quarter, which may still suggest that CARMAX is still headed in the right direction. Another reason to believe that CARMAX's business and resources are trending upwards is that about a month and a half ago, CARMAX announced it would be hiring for 3,700 new positions by the end of the year. The press release emphasized that while many companies at the moment were looking for seasonal hires, CARMAX was more interested in those seeking to build careers with the company. CARMAX plans to report its earnings for this fiscal quarter at the end of December, specifically the 28th. So that's going to be something to look forward to with this company. Meanwhile, I think that there's plenty of evidence to suggest that CARMAX is a pretty solid investment for the long term. I'll definitely be keeping this one on my watch list. So next up, we have the iShares Core S&P 500 ETF, stock ticker IVV. As you know, this is an ETF. It's not a specific company, but with the types of investing that I like to do, which is mostly long term, I heavily prefer investing in ETFs like this, so that's why I really recommend it. Right now, one share of IVV is trading at $471.24, and year to date, this ETF is up 26.74%. When you're investing in IVV, you are getting exposure to large established US companies, and that basically is the S&P 500. Here's a chart showing some of the performance over the last 1, 3, 5, 10 years, and just like we'd expect, we can see that the performance overall was very great. Right now, they have about $326 billion in net assets with total holdings of 505 different companies, and the average price to earnings ratio right now is 33.47. Fees are also extremely important to look at, and that's one reason why I really love this ETF, because the total expense ratio is just 0.03%, which makes it a great alternative to VOO, which is my other favorite ETF. Looking at some of the top holdings, we can see that they have Apple, Microsoft, Amazon, Tesla, Alphabet, NVIDIA. So yeah, a bunch of companies I've talked about in this video, as well as my past top stocks videos. And if we look at the exposure breakdowns, we can see that it's mostly in information tech, consumer discretionary, healthcare, and financials. So anyways, those are my top 7 stocks for the month of December 2021. Like I mentioned earlier, if you do want to get 2 free stocks with WeBull worth up to $2,300, I will put my exclusive link in the description below. As with all investing, I want you guys to do your own due diligence before putting your money into anything. The markets are at all-time highs, and with stocks, we really don't know if it's going to go up or down, but in the long term, we've seen that historically stocks have performed very well. That's really why I take a long-term approach to investing that I encourage you guys to do as well. Anyways, I hope you guys enjoyed the video, and if you did, make sure to hit that like button and also subscribe to my channel for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thanks so much again, and I'll see you in the next video. Peace.